If you're buying a home this year, you've probably seen listings that say assumable mortgage. Sounds amazing, right? Especially when today's rates feel painful. But here's the catch: most buyers have no idea what it actually takes to assume a loan or when it truly makes sense. Today, I am breaking it down in plain English so you do not walk into a costly surprise. I'm getting more questions about assumable mortgages than ever, and I get why. As of mid-November 2025, the average 30-year fixed rate is around 6.34%. Compare that to what many sellers locked in back in 2020 and 2021 when rates hit historic lows, some as low as 2.65%. So buyers look at those numbers and think, wait, can I just take over their loan? The short answer is yes, sometimes you can, but there are conditions, paperwork, and a few big details most buyers completely miss. In this video, I'm gonna walk you through what an assumable mortgage actually is, the real benefits of it, how to qualify in 2025 and 2026, and when it actually makes sense to pursue one. No hype, just what you need to know so you can make a smart decision. An assumable mortgage is exactly what it sounds like. You, as the buyer, take over the seller's existing loan. That means same interest rate, same monthly payment on the remaining balance, same remaining terms. So in theory, you could lock in a rate like 2.75% when new loans are closer to 6. That is a big deal for your monthly payment. In most cases, FHA, VA, and USDA loans are assumable. Conventional loans usually are not. Here is the important part that a lot of people misunderstand. The seller cannot just hand you their loan privately. You are taking over the rate, not skipping the approval process. So early in your home search, ask, is the current mortgage FHA, VA, or USDA? And is it assumable? Ask your agent. If it is assumable, that instantly becomes a powerful negotiation and planning tool. Number two, the biggest benefit is simple. Lower rate equals lower monthly payment. If a seller locked in at 2.75% in 2021, their payment might be hundreds of dollars less per month than what you would pay at today's rates for the same home. Over years, that difference really adds up. It can help you qualify for more home, give you more room in your monthly budget, and reduce your payment stress. Another bonus is that assumptions often come with fewer loan origination fees, which can lower your closing costs compared to starting a brand new loan. So on paper, an assumable mortgage can look like a win. Lower rate, lower payment, potentially lower closing costs, but that's not the whole picture. Even though you are taking over an existing loan, you are not skipping underwriting. The lender still has to approve you. They will typically look at your income. Is it stable or sufficient? Your credit score, does it meet their minimums? Your debt to income ratio, usually they want it roughly under 43% to 50%. They'll also look at your assets. Do you have the cash to cover the equity difference? You will still be asked for the usual documents like your tax returns, pay stubs, bank statements, employment verifications, your identification. One pro tip, tell your lender early that you are interested in assuming a loan, not just getting a new one. Ask if they process assumptions and what their requirements are. In some cases, you can even pre-qualify for an assumption, which saves time once you find an assumable property. Now, here's the part most buyers do not think about. Assumptions usually are not fast. Many lenders, they do not process them every day, so the timeline can be slower. In real life, you might be looking at 45 to 90 days for the assumption process, depending on the lender's workload. So if your top priority is closing as fast as possible, assuming a mortgage may not be the best fit. An assumable mortgage can be a smart move, but only when a few key pieces line up. It usually makes sense when the seller's rate is significantly lower than today's rates, when you have enough cash to cover the equity gap. Number three, when you plan to stay in the home long enough to benefit from the lower payment. Number four, when the monthly savings make up for the upfront cash that you are putting in to cover the equity gap. And then you will also want to potentially lower your closing costs. For sellers, offering an assumable loan can be a big marketing advantage. In a competitive market, being able to say that you can take over my 2 point something rate, it can really make a listing stand out. For both buyers and sellers, the numbers still have to work. You want to compare monthly savings versus extra cash needed upfront, and also the timeline to break even. So Assumable mortgages, they are not a magic shortcut, but they can be a true advantage when all the pieces line up. The key is understand the process, prepare for the equity gap, and work with professionals who actually understand how these transfers work. If you are looking at a home with an assumable mortgage, or if you are a seller wondering if your own home and your own loan could help attract more buyers, reach out. Grab a time on my calendar for a one-on-one consultation, and I will help you. I will help you run the numbers. I will help you break down your options. I'll help you decide whether an assumption is really worth pursuing. The right guidance can help you avoid surprises and use today's market to your advantage.